Well, it's Wednesday, and on the BizNews Power Hour, that means time for Magnus Heystek to be giving us all of his insights. And today, Magnus, we're going to be looking at something that has been very much on minds of people since the month of shame. Lots of people wanting to emigrate, wanting to perhaps look at a future, but there's also retirement annuities. Now, if you're thinking of emigrating at some point in time, and I guess if you're in your 20s, then it makes no sense to take a retirement annuity if you're not going to be in South Africa later on. But what about people who are a little maybe older than that? What is the situation with retirement annuities?
Yes, good afternoon, Alec. Of course, it was before the unrest in KwaZulu-Natal. Government came with certain proposed changes to under what circumstances you can withdraw money from an RA, pension fund, provident fund, when you decide to immigrate. Up to now, the financial immigration was fairly simple. You would financially immigrate and you pay certain taxes, and you will withdraw your money, and it will leave with you when you decide to immigrate. Now, that ruling was changed, so there's now a 3-year waiting rule, which is bad enough. Government has said your money must remain behind when you decide to immigrate in the formal immigration process. Now, that's already creating consternation amongst a lot of people who might be middle-aged. They might have a 10 or a 20 million rand in various retirement products that they've been told to invest in all their lives, and they need that money to set up home or an office or a lifestyle somewhere else. But now that is locked up. Now, that's already creating a lot of anger and a lot of uncertainty. And lo and behold, last week, government came with a new draft taxation bill, which said, in addition to the 3-year waiting rule, there will be an exit tax applied to those people who decide to formally immigrate. So that has not only immediate and very, very severe impact on people who want to immigrate and they need the money now. That's now very debatable how long they're going to wait and what tax rate they're going to pay. But the question many people, younger people, professional people, they might not even be contemplating retirement now, but they might do it sometime down the road. There might be another flare-up. Now, the big question is an RA still worth it? Should you even consider an RA, in the sense that it's already a very illiquid investment instrument? It's subject to Regulation 28 of the Pensions Act, which has severely impacted your growth because you only were allowed 30% offshore exposure over the last 10 years. And now you've got the uncertainty that, yes, you're building up some retirement capital, but you might change your mind. You might want to immigrate for whatever reason. It's your money. But government is actually saying, well, it's not your money. We gave you that tax-free gap to put money in. We have a right what you do with your money when you pull that out. Now, that to me is very ominous, and people must be made aware of the fact that government is already doing it and will increasingly exercise control over your retirement money, which them, together with the retirement planning industry, has been urging you to put money away on the basis that people retire with not enough money and they're going to be poor and destitute. But you putting your money into a monkey trap. You can put your hand through the trap, but you can't withdraw it. And that to me is very dangerous, and we need to debate this. And a lot of people, young people I speak to today, say, that's it, I'm not interested in an RA, and I support them in that. I say, I agree with you. It's not a viable instrument if immigration is somewhere in your future.
Let's just go through that again. So you now, if you emigrate from South Africa, financially immigrate, you cannot take your retirement annuity with you anymore. That's got to stay here locked up for 3 years. Is that correct?
That's correct. It's not only your retirement annuity, it's also your pension fund and or preservation fund. So, it's the retirement capital now stays in South Africa. You can go. You and your family can go. But the money remains behind. You start your process, and you have to come back 3 years later, and you have to prove to someone in Treasury, I have immigrated. Here's my proof. I have a home, I have a job. Can I please have my money? And now government last week came with another addendum to the tax law saying, well, we're gonna tax you when you take out your money over and above the normal tax rates that are applicable.
All right. So you've paid into your retirement fund through pre-tax money. You get a tax benefit. And as a consequence of that, government is now putting all these regulations in place or putting all these rules in place. How big is that tax benefit, Magnus? Is it, and I guess that's the question, is it really worth it? Or should you rather just be investing in something where you don't get a tax benefit?
No, it's a tax delay. You don't get it really. If you actually be brutally honest, and I'm one of those who said, I don't think it's a worthwhile investment. I don't personally market them to my clients, but there are big companies who do, and they all focus on the tax, you're saving tax. I say, hang on, guys, sit back a little bit. You get the tax relief now, and 10 or 20 years later or 30 years later, you're going to be taxed again when you withdraw your money. Yes, there are other elements that we don't have enough time to discuss, but apart from the 500,000 tax-free at this stage, which hasn't been changed for many, many years, it's actually declining in real terms, the balance of your capital will be taxed. So it's a bit of smoke and mirrors. And if you start doing after-tax and pre-tax numbers, there's no question that the last 10 to 15 years, you were better off not putting money into an RA, but rather pay your tax now, so you've got tax certainty, and then you invest it yourself, and then you can choose where you want to invest it. And the returns have been double or treble than within the Regulation 28 product.
Yeah, that's what I was going to ask you about. If you go through a retirement annuity or retirement funds, then 30% of that is allowed to go offshore, which has performed well. In other words, the whole market, the 99% of the investable assets that are outside of South Africa. If you don't, then you forego whatever tax benefits there would be, but you could invest 100% if you liked into an offshore asset, for most people anyway.
Quite correct. You can, and I advise people rather pay your taxes, and then you start with, if you want some tax benefits, you can use the tax-free saving instruments. You can get 100% offshore and at a very cheap level. And if you've got more money than that, use your 1 million rand investment allowance that you simply just take out and start creating an international portfolio. And I'm discussing this at the BizNews conference in the mountains in about 2 weeks from now, saying that is the strategy that I recommend, and here are the facts. Because one of the stats that will show you that the last 8 years, no pension fund, well, not say no pension fund, on average, the average retirement annuity pension fund, provident fund, has not beaten the inflation rate. Now, that's a huge number. You've made no money. Why are you putting money in? And now government controls your money and says, we will allow you to take the money when we decide to do so. So government has created a precedent. They can now tell you, we're going to keep control of your money for 3 years. It can be 5, it can be 10. Now they're coming with a tax as well. So very clearly, that's a very clever way of starting to gain control and add punitive taxes, which were not there when you made the investment. So you've got absolutely no control over what government decides or does or does not do in the next couple of years. And that, to me, is not a way to build a secure financial life. Now, of course, I'm speaking up against the big insurance companies with very smart people who wear ties every day to work. And they are very smart, and they're very, very good marketers. And they can sell soap to the Eskimos, or maybe ice is the better one, but they make it so convincing. But I just don't. And we internally at Brenthurst, we often discuss this, and I've got a couple of young actuaries working there, and they agree with me. We cannot scientifically or make a very powerful case for advising our young clients to build a portfolio in an RA, considering all the uncertainties.
Magnus, are the big companies taking the government on with this proposed additional tax? Because if you would if they are serving their clients, if they're serving the customers, those who do have retirement annuity funds with them, then you would presume that they'd be lobbying aggressively against government to put yet another obstacle in the way of this, what has been a very lucrative product for them.
Why would they, Alec? Government is saying, or adding them in, keeping that money in South Africa in the net even longer. I don't think that any company will aggressively lobby government and say, let these guys take their money earlier, because that means 3 years less of income on the funds invested. So they'd rather say, hang on, we'll sit back and let government fight this one, because it's not in their interest to go and make the fight. It's actually to their benefit. The longer it stays in the tax net or in the RA net, the pension net, the better for the company. So, I don't know, but I don't see them forcibly arguing this case, and not. So nobody's actually getting up and fighting for the poor consumer. There's no lobby group who will benefit because it's such a scattered industry. The poor investors themselves don't fully understand what's really happening to them, but it is happening to them. It means less money in future whenever they decide to leave the country.
But I find this all very short-sighted, because if you are a company that is serving consumers, you have to put the consumer first before your own interest. A little bit like the ANC putting the party first before the country. It's a fool's errand. In the end, you are going to lose. It's just when.
One would think in an ideal world that would be the case, but it's not the case. We've had this Regulation 28 thing for a very, very long time. We still have companies, very big insurance companies, that penalize their investors in the old style retirement annuities with massive punitive penalties when they pull out the money. They were kicked screaming by Trevor Manuel 10, 12 years ago when the penalties were even bigger. So they will not put the customer first, especially when we're talking about these numbers. We're talking about hundreds and billions of rands that is at stake. And they're definitely not going to go and make a case for the man, because they can argue and say, well, these people are disloyal. They're leaving the country. They're taking money away. Why should we help them? And I think that is also the tone of the Treasury spokespeople. They basically said, well, we gave these people tax incentives to build up some retirement capital, so we have a legal right to once again step in and determine how and when they can withdraw that money. Well, yeah, that might be true, but I can tell you now, if the message gets out to the broader investment community, the self-employed business people, they're not going to touch RAs. It's going to become a very, very toxic product to sell.
So we understand your advice is very clear. Don't buy a retirement annuity. But what about those people who are employed by big companies and they have to produce or contribute 6% of their salary every month into a pension fund? Are they also going to be prejudiced by this new tax and indeed the 3-year rule if they were to intend immigrating at some time in future?
Yes, indeed. They will also be penalized. They don't have a choice when they join, and very little investor choice. Strangely enough, before I omit to mention it, there are certain cases when I do recommend RAs, and I recommend it primarily for people older than 55, where they can use very cleverly their contribution benefit to get their tax-free option back. So they do 2 annual single premium RAs of 247,000 Rand, which you withdraw almost immediately a week or two later and get the cash out, but you've got the tax relief in your books, and you do it again the next year. So you can, if you're smart, you can use that loophole to get the tax relief and get your money out. And thereafter, if you are older than 55 and staying in South Africa, you can use the RA contributions every year and immediately move the money to a living annuity. And I do that with my money, my own personal money, and to my clients are saying, You stay in SA, you need the money, so put it in RO, get the tax relief, and immediately move it across to a living annuity where you can get 100% offshore exposure. And that's been a very, very smart strategy to follow. It's the younger people building capital over time, and it comes down to the regulatory strangulation of Regulation 28, where we're saying you may not invest more than 30% offshore. And that to me is a very, I know it's a political reason. There's fears that if they open the gates, a lot of money will leave the country. But it's impoverishing people in those investment instruments.
Magnus, just to close off with, if you do then contribute every month to a pension fund at the company, if the company forces you to do that, is there anything you can do about this, excepting going to the trustees and perhaps trying to get them to change the rules?
That is the first way to do it. You go to the trustees, you start writing to them. They are acting on your behalf. They're the liaison between you and the investment company. But in my experience, I was a trustee of the Argus pension fund. You might recall the Argus company. They just rubber stamp. They don't listen to you. They smile when you talk, and off they go. They're acting not on your behalf. They're acting on the behalf of their employers, who are the big asset managers, and off they go. So once again, the odds are stacked up against you. I mean, we need to question this Regulation 28, and 30% is enough for you. Sit down, young man. 30% is enough for you. And secondly, your asset allocation for someone at 25 and 55 is exactly the same. And we've been taught from day one, young people should be taking investment risks. They should be investing in Apple and Google and live with the volatility. But here we are, one size fits all as long as it's black. So shut up and be happy with that. And so there's something bubbling under the surface as far as retirement funds are concerned.